Okay, and welcome back, students who are taking financial accounting. And in this series of videos, we are working on the assigned homework problems for Chapter 9, the short exercises. All right. Note, accounting is about understanding the concepts and then applying that understanding to the situation at hand. If you get the application aspect wrong, that is one thing and is easily remedied by watching someone else work the problem. However, if you don't understand the concepts, that is a whole other thing. Watching a problem worked out will not help you if you don't understand the underlying concepts. Go back and study the text material again and watch the theory videos. If you still don't understand the concepts, then either email or telephone an instructor to get help with that understanding. And this slide is very valid. The idea on this slide is very valid when it comes to bonds. If you don't understand the theory behind the bonds, the underlying concepts, it's difficult to do the problems. So go back and rewatch the theory videos and get the concepts down. And if you get the concepts down and you still get the problem wrong, then you can, that's remedied easily by watching me work it out. But if you don't understand, how to calculate interest, or you don't know what amortization is, or whatever, the theory that you're missing that you don't understand, it doesn't matter about the application. You're just not going to get the problem. So I point it out because, as we work with bonds, and these are the short exercises, as we go forward, the problems are going to get more and more difficult. So make sure you've got the theory down. All right. So 9/11. Get my pen here. All right. So Allied Corp issued 8% 5-year bonds payable with a maturity value of $50,000. So $50,000 at 8% for 5 years at a price of $48,200. Okay, so if the bonds are at 50 and they're issuing them at 48.2, that is at a discount, right? Because it's below the par value of 50,000 on January 1st. So journalize the following transactions for Allied. Include an explanation for each entry. So on 1/1/2014, the question we ask ourselves is, am I affecting cash? Yes, I am affecting cash, right? What am I getting? I'm getting $48,200. So I debit cash for $48,200, right? Now, in getting the cash, remember, we have to remember debits have to equal credits. So in getting my cash, right, if you think in terms of par, I would have to credit something else. Well, that would be a bond payable, right? And my bond payable in this case, meaning what am I going to have to pay, 5 years from now, will be the 50,000. Okay. Well, my debits don't equal credits, right? In this journal entry, so I'm going to have to debit something else. Okay. And what am I debiting? I'm debiting the discount on the bond payable and for the difference in the amount of $1,800. So that is my journal entry for the issuance of the bond payable on January 1st. It says payment of the semi-annual interest and amortization of the bond discount on July 1st. Use the straight line method to amortize the discount. So on July 1st, 2014, we're going to make an interest payment. All right. Now, remember that you have two components here. You have the payment of the interest that's as part of the face value of the bond itself, okay? And you have the amortization of the discount amount between the face value and the price. So go back and watch the theory videos. I covered that, in the theory videos as to why we're amortizing the discount. So again, I'm not going to go back over all of that. Go back and watch those theory videos. So for this problem, right, we're going to pay out, we're paying out the interest for the semi-annual payment. So if I'm paying, am I affecting cash? Yes, because why I'm paying out the cash for the interest. So I'm going to credit my cash, and the question becomes how much, all right? So if I have 50,000 times 8%, and it's for 6 months semi-annually, so it's 6 over 12, and that's going to equal $2,000. Okay, or I could have gone and said 50,000 times 8%, right, is $4,000, right, and I'm doing that twice yearly, so that's going to equal $2,000, right, of interest on each payment. So I'm going to pay out cash in the amount of, oops, wrong thing here. I'm going to pay out cash, so I'm going to credit my cash for $2,000. Right? Okay. And now I need to amortize the amount of the discount, right? So I have the discount here of $1,800. Okay, so I'm amortizing that discount on the bond payable, right? So if I have $1,800 of interest, right, and of discount, and remember this here's for 5 years, but we're making semi-annual payments, so it's 5 years. So it's 5 years times twice a year, right? So that's 10 periods, right? So if I take my 1,800 and I divide it by the 10 periods, that's $180 that I'm going to amortize each and every period. Okay, so my I have a discount on the bond payable, right? That was a debit, so I'm going to credit my discount on the bond payable for $180, right? And before I go into the last portion, last half of this journal entry, remember, go back and watch the theory videos as to why I'm debiting, I'm crediting my discount on bond payable. Remember, at the end of the maturity value, this discount should be 0. So we're amortizing that amount over the course of the 10 years. And as we make each and every one of those payments, the amount of this here discount gets less and less and less, so that by the end of the bond, when it hits maturity value, the value of that discount on bond payable will be 0. So that's why we're crediting it to offset the debit of that discount on the bond payable. Right now, for the last portion of this entry, debits have to equal credits. Okay, and what are we doing with this? Well, it's an interest expense, right? Because why we're paying out the interest on the semi-annual payments for the bond. So the debits have to equal credits. We have $2,180 in credits, so we have to debit $2,180 in interest. Okay, and so that's it for this particular problem, right? I am not going to go back over this. I'm not going to summarize it. Watch the video again, and if you're still not getting it, I'm highly recommend that you watch those theory videos again, okay, and get it down. I mean, it's one thing to say, okay, remember, think about the step up we're making from problem to problem here. In the last exercise, it basically said we're at par, okay, and so here's how I issue the bond, here's my interest payment, and here's how I pay off the bond, okay. Now we went up and we said, we got a little bit more complex here by saying, okay, now we have a bond at a discount. Well, notice that this here entry for the discount on the bond payable is different from when it's at par. Associate in your mind the difference between the two, okay? Primarily because of the discount, right? And then also, look at the interest payments, when we have to pay them every semi-annually. Well, what's the difference in making that calculation for the interest payment? Well, it's the amortization of the discount. Okay, that's the difference between that one and, and that one there, right? And then finally, which they didn't ask you to do in this, all right, is to, when you pay out for the maturity value, okay, which ends up being basically the same thing as this one here. Let me get my pen, which ends up being the same as this entry here. Why? Because the discount is already, other way. Because the discount on the bond payable has been amortized over the entire time. So all you're left with is just paying out the cash and washing out the bond payable general ledger account itself, getting them to zero. So I think that's why they didn't have you do C and record it as a, the payment at the end, because it's the same as the previous slide. Right, so notice that this here slide got just a little bit more difficult by thinking about the discount, and I'm sure the next problem, and I haven't looked at it, will probably be about a premium. So if you've watched the videos and you still don't understand something, then feel free to telephone and speak with an instructor and we'll help you out. All right, things are getting more and more difficult. All right, so with that, see you in the next video.